Emerging markets have had, in many ways, a surprisingly good year thus far, but are ETFs the way to invest in them? This is Inside ETFs, and we're talking emerging markets. Despite the US tariffs that have threatened to upend global trading relationships this year, the stock markets in a number of emerging countries have proved surprisingly resilient. Exposure to China has even proved a good thing for funds, even as trading relations between China and the US have fluctuated wildly. So how can investors take advantage of this? Stephen Schoenfeld is CEO of MarketVector Indexes. Stephen, in a broad sense, given the trading uncertainties, this all looks a bit counterintuitive, doesn't it? How do you explain the success this year?
So emerging markets have underperformed for much of the last 10 years. And so there was inevitably going to be some catch up. Ironically, the high level of debt in developed markets makes emerging markets seem relatively attractive because they've dealt with their debt issues for the most part over the past 5 to 10 years. Plus, in an environment where interest rates are expected to go down, economic growth in emerging markets should benefit. Last and definitely not least is many of the biggest emerging markets, despite all the turmoil around the world, have very large domestic markets, and that allows them to grow despite the turmoil in global markets, especially the issue of tariffs.
Why then should investors use a broad emerging markets ETF?
So over the years, one could make many cases to be specialized, especially because the broad-based indexes are highly concentrated with 70% plus of MSCI emerging markets in just 4 countries, dominated by China. However, China also, after several years of underperformance, has surprised on the upside. And so, ironically, the standard emerging market benchmarks, the ones that are cap weighted, have heavy weights towards some of the big countries, have done better than some of the indexes and ETFs that try to get fancy, whether value tilts, dividend tilts, alternative weights. So this is the year, at least year to date, where the big cap-weighted markets have done well.
How much do individual trading relationships with the US matter?
It depends very much on the country. So if it's a very large emerging market, whether it's India or China, the tariffs China, we still don't know what the tariffs will be, but in India, they're going to hit in a day or so. It will affect exporters, but as I said before, there's large domestic demand. Brazil, for example, has been quite resilient because its domestic market is large and it has strong export relationships with China that have insulated it. And I don't love the whole concept of the BRICS either as an investment theme or as a new country grouping, but the BRICS are trading more with each other, so it's creating some element of self-sufficiency. The tariffs matter. Smaller emerging markets will be impacted greater.
Let's zoom in, Stephen, on India, which you mentioned there. There's a 50% US tariff on Indian exports kicking in on Wednesday. Can India cope with that?
So India has made statements very much to the point that it will cope with it. It has not been one of the countries coming to Washington and kowtowing to the administration. They are gearing up for a long struggle on these tariffs. India's domestic market can absolutely survive and thrive. The growth of the Indian middle class, the reforms in the financial sector in India are all going to drive domestic demand. However, certain export areas, particularly textiles, but also tech, can be hurt. And hopefully India will find a way to create some kind of modus vivendi with the US administration. But in the short term, it will hurt. The Indian market had several very, very good years, but it stalled in October, not primarily because of tariffs, because of other factors. But now we've seen India underperforming for almost a year. And that, in my opinion, actually creates opportunity.
More broadly, do you think emerging markets ETFs are, as you say, a long-term prospect? Do investors have to look past, for example, trade relationships, tariffs that keep on changing?
So emerging markets, almost by definition, are always in a flux and always in change. But emerging markets started this year more than a third undervalued compared to developed markets, and they're still quite undervalued. So most global investors are still underweight emerging markets. To just get back to neutral weight, I think would be a prudent decision by investors. And ETFs give you that efficient exposure.
That was Stephen Schoenfeld of MarketVector Indexes. Don't forget, you can watch more videos on Reuters.com.